Hey everyone, welcome back to Corporate Decoder, where we decode the hidden messages in corporate filings, and today's filing is all about more debt, just what we all wanted to hear. Today we're looking at a filing from Blackstone Private Credit Fund, and it's about them issuing more debt. Now normally this might sound a bit dry, but for a credit fund, this is actually a pretty big deal. It tells us about their growth strategy, how they're funding it, and what kind of risks they're taking on. So what exactly happened here? Well, on the 23rd of December 2025, Blackstone Private Credit Fund, which we'll just call the fund, decided to issue a cool $100 million worth of new notes. These are officially called 6.250% notes due 2031. Think of them like loans that the fund is taking out from investors, promising to pay them back with interest over several years. Now, this isn't entirely new for them. They'd already issued about $500 million of these same type of notes back in January of 2024. So this $100 million is like adding another chapter to an existing story. The really interesting part is that these new notes will be mixed in with the old ones, acting as if they were all issued at the same time. They'll share the same Accession number, which is like a unique ID for financial products. And they'll be completely interchangeable with this new issuance. The total amount of these notes outstanding now jumps to a hefty $600 million. This tells us the fund is confident in raising capital and is likely expanding its lending activities. These notes are set to mature in January of 2031. That is a pretty long time, giving the fund a good window to operate and grow. They can pay them back early if they want to, but that depends on the terms laid out in the agreement. The interest rate is fixed at 6.250% per year, paid out twice a year. On the 25th of January and the 25th of July, the first interest payment on this new batch would have been on the 25th of January 2026. Now, let's talk about how these notes rank. They are what is called general unsecured obligations. This means they are not backed by any specific assets. If the fund were to run into serious trouble, these note holders would be paid back after anyone who has secured loans, meaning loans backed by specific collateral. They also rank junior to any debt taken out by the fund's subsidiaries or other financial entities. This is a pretty standard structure for this type of fund, but it is important to remember. It means that in a worst case scenario, these note holders are not at the very front of the line for getting their money back. The agreement for these notes, called the indenture, has some important promises from the fund. They have to keep their assets covered according to certain rules, like those in the Investment Company Act of 1940. Even if they aren't strictly required to follow those rules because of their structure, they've agreed to do so. They also promise to keep note holders and the trustee, which is essentially the administrator of the notes, informed with financial information, especially if they were to no longer be subject to ongoing public reporting requirements. These promises are crucial for investor confidence. One of the key protections for investors is a change of control repurchase event. This means if a significant change happens at the fund, like a merger or something that fundamentally alters who is in charge, the fund generally has to offer to buy back these notes at their full principal amount plus any accrued interest. This is a good safeguard to protect investors from unpredictable shifts in ownership or strategy. These notes were made available to investors through a registration statement filed with the Securities and Exchange Commission, or SEC. The filing date for the registration statement was the 30th of January 2025, and the actual deal closed on the 23rd of December 2025. This shows they went through the proper channels to offer these securities to the public. Now, let's quickly look at some of the exhibits listed. The underwriting agreement details the deal between the fund and the institutions that helped sell these notes, like Wells Fargo Securities and KKR Capital Markets. This is where they agree on the terms of the sale and the fees involved. Exhibit 4.1 references the original base indenture from September 2021. This is the foundational document for all the notes issued under this program. Exhibit 4.2 refers to the 12th supplemental indenture from January 2024, which likely covers the initial issuance of these 6.250% notes due 2031. And finally, Exhibits 5.1 and 5.2 are legal opinions from law firms Simpson Thacker and Bartlett LLP and Richards Layton. And fingerpart these opinions confirm that the notes have been legally issued and are valid obligations of the fund. They are basically ensuring everything is on the up and up from a legal standpoint. So what does this all mean for Blackstone Private Credit Fund and its investors? Well, this filing tells us the fund is actively managing its capital structure and signaling a need for more funding. For investors, it means more opportunities to lend to the fund. But the unsecured nature of these notes is a key risk factor to consider. The fund is essentially borrowing more money to presumably lend out more money, which is the core of its business. The fact that they're adding to an existing series of notes suggests strong demand for their lending services and a willingness from investors to provide that capital. However, we always need to look past the positive spin. While increasing debt can fuel growth, it also magnifies risk. If the fund's underlying loans perform poorly, or if there is a broad market downturn, the increased leverage could lead to greater losses. The covenants and the change of control provisions are important safety nets, but they don't eliminate the inherent risks of taking on more debt. The success of this strategy hinges on the fund's ability to judiciously select and manage its loan portfolio. In conclusion, Blackstone Private Credit Fund is expanding its debt to fuel its credit activities. While this shows confidence and growth, investors should be mindful of the unsecured nature of these notes and the general risks associated with increased leverage. It is a balance between fueling growth and managing potential downsides. Alright, that is our breakdown of Blackstone Private Credit Fund's latest filing. What is your take on companies increasing their debt to fund expansion? Do you see it as a sign of strength or a ticking time bomb? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community linked in the description below for more discussions. Thanks for watching. See you next time.